Tuesday, February 16th. I'm Holy Joe Rock and Roll coming at you live and unscripted, and this is Currency Exchange and Fed Update. The Fed is currently on a tightening bias, right? The initial plan is to raise interest rates possibly another 2 percentage points over the course of the next 4 to 5, 6 quarters. Now, many people in the past have argued that the Fed is the reason for the boom and bust cycles in the United States. And here we can clearly see what is happening. That the Fed says that they're going to be data dependent, but may be stuck on this autopilot course. Now, Janet Yellen gave some slightly dovish statements saying that they are data dependent and they may take into account other factors, right? Globally, before they raise interest rates. Many people have argued that the Fed has kept interest rates artificially low for too long. In December of 2015, they finally started raising interest rates. And now you can see that the timing is all wrong, right? Now, I'm not someone who has ever argued for zero interest rates forever, but in the current environment, it appears that the instability of the stock market is partly because of this implied Fed rate hike, series of Fed rate hikes that are coming. We know that China is weak, Russia is weak, Brazil, India, all of these BRIC economies which were supposed to take over the world, they're all weak. Right? Mainly because China is weak, because a lot of these companies were exporting to China. And that was sort of the basis or the strength of their economies. Australia also weaker. The US dollar, of course, has gotten stronger over the last 2 years and still remains strong, although it is sort of eased back a little bit on some currencies. It's a little bit weaker against the euro and a little bit weaker against the Polish zloty. But today I saw that it is stronger against the Swedish crown, and also the Taiwanese or the Korean won. So the dollar continues to stay strong. And this is also part and parcel to the fact that oil prices are lower, in part because of the strong dollar, but also in part because of the oversupply of oil. Now, any of those people who have argued that there was a peak oil period, I mean, this was just pure nonsense. And with oil down in the 30s, possibly go into 20s and maybe trading in a range of $20 to $40 over the next 2 years, it's pretty clear that there never was a supply shortage, right? There never was. And the fact that Saudi Arabia can boost production extra 2 million barrels per day, right? And that's what they've been doing, around 10, 12 million barrels a day, even at this low price, means that when oil was $150 a barrel, they certainly could have boosted their supply of oil, right? That would have alleviated the recession that was caused by that. $150 a barrel oil really helped put the brakes on the U.S. economy and helped really create a crisis in the United States. That and the housing collapse kind of came one-two punch and really brought the United States into a deep recession, which we really haven't recovered from. So, to ever consider Saudi Arabia to be an ally, really, or OPEC, of course, has never been an ally. It's a cartel. And now what's happening? I mean, the logic for Saudi Arabia to be refusing to back down, although 4 countries have supposedly agreed to maintain oil production at the current level, not to go higher. Russia, Saudi Arabia, Qatar, and maybe Venezuela, those 4 countries, decided to remain at the current levels. That means that we're going to see oil for less for longer for sure. Okay? And this attempt to crush the independent frackers in the United States, I think it's playing a fool's game. Because luckily the Americans have played a different game, right? Maybe in the beginning, fracking costs $65 a barrel, maybe in the beginning, right? They were profitable at $65 a barrel, even though oil was at higher, it was 80, 90. So they were definitely making a lot of money. But as the technology has improved and been refined, we're seeing frackers in the United States being profitable as little as $35 a barrel. Now, certainly once you've already drilled and you have a production, you can pretty much end all CapEx except the very minimal CapEx, right? And if a well costs, say it costs $10 million a barrel, $10 million to drill a new well, and I don't even know if that number is accurate, but let's call it $10 million, right? If you're getting 5,000 barrels a day, even at $30 a barrel, that's $55 million a year in production, right? So certainly that is profitable for a single well, assuming that it can produce that much, or whatever. So that's still profitable, right? I mean, it's not as profitable as before, but it's still very profitable. So I think any attempts from the Saudis to knock out the United States production is just a wet dream. It's just not going to happen. And if oil goes up to back to $60 a barrel, these puppies can just crank up their volume again, right? But we're already sitting on basically a oil. Some of these guys are saying that there is so much oil that there's no place to put it. They're going to start putting it into swimming pools, right? Just to park the oil. All right. This has been your update. I'm Holy Joe Rock and Roll. The Fed really needs to put the brakes on their automatic pilot plan to raise interest rates. The conditions on the ground, the real numbers, the data dependency has changed radically. And because the economies globally are slowing, the U.S. does not need to raise interest rates. You raise interest rates to slow down growth, right? And there is not enough growth to demand it. So if the Fed does this autopilot of raising interest rates, then anybody who had claimed in the past that the Fed has been inducing these boom bust cycles, it's going to be really clear and obvious that the Fed, by their bad policies, is going to create another recession in the United States. I'm Holy Joe Rock and Roll. This has been your update, February 16th, Tuesday, 2016. Take care and be well.